Hello everybody, this is Jason Fields, Certified Financial Education Instructor, and I want to say good afternoon to all my LinkedIn family, Twitter family, Facebook family. As I said before, I told many of you that I would be doing a video to go over some of the things that we taught in class last month and early this month. And the course that we did, or we just completed, was how to invest like Warren Buffett. And so briefly what I'm going to do is give you some rules and then characteristics to determine how does Warren Buffett invest. There go, hopefully you can learn something and begin to use the same approach. First thing you need to know is that Warren Buffett has basically a philosophy, and I got this out of a book written by Matthew Crater, who is the CEO of Trader University, and his book is titled Invest Like Warren Buffett. And part of what I do is, in reading information and going through many books and articles, I want to find things that make it simple, that people can grasp right away, and then put into practice. And so he wrote this book, and I thought it was an excellent book to get individuals, beginners particularly, and people who are sort of intermediate investors to start differentiating between how to go into a market, how to look at a company. And so two things that Warren Buffett does is his mindset is that there are two types of companies. There are great companies, and then there's everything else. And for all of us, particularly you beginning investors, the goal is to find great companies. Now remember, there are two types of companies: a great company, and then there's everything else. Not to say that everything else is bad or horrible, but he believes in the fact that if you really want to start looking at investing, you should adopt that mindset. There are great companies, and then there's everything else. And so the first question that you want to ask, or that you're going to ask me, is, well, how do we recognize a great company? And so Warren Buffett, per Matthew Crater, says there are 5 ways you can determine what's a great company. There are 5 ways you can determine what's a great company. The first one is it has to be a simple business, meaning it has to be a great business. A great business is simple. You should understand what they do. You should understand how they make money. And so that's your first characteristic of what a great business is. You understand it. You know what it does. You know how they make money. Second, it has to have brand recognition. A great business usually has brand recognition. For example, if I took away the words and showed you the logo for Starbucks, Apple, or Nike, you guys would recognize that right away without the language or the words underneath it on the logo. You would recognize that. And those logos are recognizable worldwide. Third, it has to sell products or services that never go out of style. In essence, the products or the services that they use will never go out of style. And fourth, consumers will purchase that product or service again and again. They will continue to purchase that product despite the fact that the price may go up, which is our 5th characteristic. It has to have pricing power, meaning people will buy that product over and over again despite the price for the most part. So with that said, let's look at what makes a great company, and then let's look at the characteristics of everything else. So as I told you before, the first 5 things you want to know is how to recognize a great business or everything else. Number 1, a great business must be simple. Number 2, it must have great brand recognition. Number 3, it must sell a product or a service that will never go out of style. Number 4, people will purchase that product or service over and over again. And number 5, it has to have purchasing power, meaning despite the fact that the price may go up, people will continue to purchase it. So that's a great business. And once we determine what potentially may be a great business, then there are some rules that a great business must have. And so we're going to get into that. So I picked Intel, and I also picked CocaCola. These are 2 companies that you know, you've heard about them. You may not necessarily know what Intel does. Some of you will, some of you may not. But for the most part, you heard of them. And so we're going to go through what makes one of these great and what makes the other one just like everything else. Again, it's not necessarily that it's bad, but it may not, based on the rules, be a great company. So the first rule that we are looking for if we believe it's a great company is that they must have earnings that will show a smooth upward trend. Now, what I like to use is value line, and you guys can see this here. And value line is a service. You can use it for free unless you are a person like me where you want more information, then eventually you got to pay for it. I like value line because it gives me the historical data and it gives me all the numbers and the things that I'm looking for. So the first rule is a great business will have earnings that show a smooth upward trend. So I'm going to go to this sheet, Intel, and I'm going to go to my far right and I'm going to look at earnings. And now I'm going to look at earnings here and I'm going to see if it has a smooth upward trend. 0.53, 0.51, 0.86, well, 1.16, 1.40. Okay, we have a dip here, 0.86, then 1.18, 92, 0.77. We jump to 205, 239. We're back down to 213. So we're looking at this, and the first question is, does it have a smooth upward trend? Well, when we look at that, the answer to that would be no. The second question, a great business will show a consistent return on equity above 20%. So I'm going to go down to return on equity, and you can see that here, return on shareholder equity, and we're looking for a consistent return above 20%. Now, I don't want you to get fooled by the number here because that's currently. Again, we're going to go back to as far as this data has been reported, and we see 16.3, 13.5, 10.5, 23.7, 28.2, 21, then we see 16, 21, 18, 19, 19, 19. So, is this a great business? Well, based on a consistent return of equity of 20%, the answer to that would be no. Again, not getting confused by the fact that we see 22% here currently. Third rule, a great business will show a consistent return on capital greater than 15%. Return on capital right above return on equity here. And so we're looking at the return of capital 15, 12, 10, 22, 24, 17, 13, 17, 14, 15, and so on. So the third question, or the third rule, does it show a consistent return on capital greater than 15%? The answer to that is no. Now again, this is Intel, and most of you have heard of Intel. So far we've answered no to the first three rules out of the 5. The fourth question, or fourth rule, you should invest in companies where the long-term debt could be paid off within 4 years or less using net profits. So again, when we go to value line, we're going to go to net profits, and we see here that this is roughly $18 billion. So we look at the net profit, 18 billion. Now we're going to look for their long-term debt, which is 1, 2, 3, 4 rows down, and we see that the long-term debt is 10 billion. So could they pay off that long-term debt within 4 years? The answer to that is yes. So basically what you would do is you would multiply the net profit number by 4 and basically see if you could get rid of this debt or pay it within 4 years. So they can do that. The fifth rule, a great business pays a dividend or it buys back stock. And we look here at dividends declared per share. We're going to go up to the top here. And as you can see, there's consistent dividends there. So that would be a yes. So Intel, using our example, looking at this sheet, is a 3 out of 5. There's a 3 out of 5 on whether Intel is a great company. So I would say no, based on the rules. Now again, it's not necessarily that Intel is a bad company, but if we're looking at great companies, particularly for you investor beginners, there might be some other buys or some other moves you can make. Now let's take a look at Coca-Cola. And what did we say the characteristics of a great business was? Number one, it had to be simple. If I asked you all what Coca-Cola does, I don't believe there's anybody that would say they have no idea. Number two, does it have great brand recognition? You would recognize that shape anywhere in the world. Does it sell products or services that never go out of style? Correct. Will people purchase Coke over and over again? You better believe it. And number five, does it have pricing power? There are people that if Coca-Cola went up to $3 a can, that would still purchase 12-ounce cans of Coca-Cola. Now, since we see that it meets the characteristics of a great business, let's see if it follows the rules of a great business. Remember, the first rule is we look for a business that will have earnings that show a smooth upward trend. So we're going to go here to our far right. We're going to find earnings, the third row down, and we're going to look up 2001, 0.80, 2002, 0.83. And if you look at this number, you can see that's a consistent, smooth upward trend. So first answer, yes. Now remember, in Intel, that answer was no. So here in Coca-Cola, the first rule, that's a yes. Smooth upward trending earnings, positive, yes. Number two, a great business will show a consistent return on equity above 20%. So we go down, we look at return on shareholder equity, reported in 2007. Third row from the above the paragraph that describes Coke's business, 27.5, 34, 27, 26, 28, 27, 28, 30, 34, etc. So the number we're looking for is a consistent return above 20%. We see that. We see a consistent return. At no point in time was it below 20%. So that's a yes. Number three, the third rule. Is there a consistent return on total capital greater than 15%? Well, right above shareholder equity, we're looking at return on total capital. Remember, the number we're looking for is consistently above 15%. 2007, 24.2, 30, 23, 18, and so on. So again, we see a number consistently above 15%. Number four, the fourth rule, could the long-term debt be paid off within 4 years using the net profits? Here we see 10 billion net profit, long-term debt, roughly 30 billion. So we multiply that 10 times 4, $40 billion. Yeah, in 4 years they could pay off their long-term debt. Does it pay a dividend or buys back stock? We scroll up, the dividends declared, and we see here more consistent return of dividends. And so all the rules, Coca-Cola meets all the rules, all the standards, and that answer is a yes. So here, what we determine is that even though there may be companies that you've heard of, if you're a beginning investor, and even if you're intermediate, you may want to really buy. Am I investing in a great company like Coca-Cola, or am I potentially investing in something that's like everything else? Again, not to say that it's necessarily bad, but it may not be a great company. This is just a little bit of what we covered in class, and I wanted to make sure I posted this so you guys could see. Eventually, we'll do some more classes on these kinds of investments and this kind of research and data gathering. But just so you have this, so you know, one of the ways you can find this kinds of information is to go to Value Line, or if you know the name of you have the ticker symbol. For example, you could type in KO Value Line, and you'll see this information will pop up. That's an easier way to do it. You go here, and of course, there it is. You'll have that information. Now, Value Line may not report all the stocks that you're following. You can use information and go to other sites, but again, for beginning investors, I like Value Line because you have the data and you can get started in knowing whether you're investing in a great company or a company that's like everything else. This is Jason Fields, Certified Financial Education Instructor, CEO of the Financial Promise. Glad you guys are paying attention. Look forward to helping you out. Make sure you follow me at www.thefinancialpromise.com. You can go here and see all the times where I'm going to be adding classes, and you can see videos, things that we're going to be consistently teaching and touching upon. Right now, cryptocurrency and Bitcoin that's major. A lot of people are talking about that, and we just did a radio show that talked about that. And so you guys can go to the website. You'll see videos that to talk about it and give you an introduction to Bitcoin and cryptocurrency. Talk to you guys later, and if you need me, feel free to reach out to me anytime. Talk to you later.